In this video, we're going to be ranking the most common assets people invest in from F tier to S tier, just like we did with business models. It goes without saying, this is not financial advice, okay? We're just looking at the data, the returns, and the risks, then stacking everything into one tier list for easy reference. So to make it simple, we're going to look at what statistically would happen if you put $100,000 into each tier. Some will shrink, some will crawl, and a few will build life-changing wealth. So without further ado, welcome to Alux. Let's dive in. All right, first up, F-tier assets, the worst wealth builders. Now, F-tier assets are financial traps, okay? They're not really investments. They're more like hobbies, status symbols, or outright gambles that disguise themselves as wealth plays. They look exciting on the surface, but they destroy wealth over time. The clearest offenders are lotteries and gambling, okay? Americans spend over $100 billion a year on tickets, according to the North American Association of State and Provincial Lotteries. The average adult throws away more than $1,000 annually chasing these jackpots. The odds of winning are roughly 1 in 300 million. Statistically, you're more likely to be struck by lightning than to build wealth this way. Luxury consumer goods, cars, watches, jewelry, designer fashion, even the newest phone bought on debt also belongs right here. These are not assets. They are liabilities. A brand new sports car might lose half its value in the first 5 years. Warren Buffett has long warned that cars are the worst investments you can make if you think in terms of return. The same logic applies to status goods. They make you look rich while quietly draining your capital. Then there are collectibles bought without expertise. From Beanie Babies in the 1990s to NFTs in 2021, fads convince beginners they found a shortcut to fortune. But without industry-level knowledge and patience, most end up worthless. Even in established categories like art or rare cars, liquidity is a killer. You can hold a valuable piece, but if no buyer comes along, the money is stuck. What unites all F-tier assets is confusion between consumption and investment. They're emotional buys, not financial ones. Real assets produce cash flow or compound in value over time. F-tier assets, they do neither, okay? They drain your wealth while tricking you into thinking you're playing the money game. Now imagine putting $100,000 here. In the lottery, it vanishes. In luxury goods, it loses half its value in just a few years. In speculative collectibles, it may never find a buyer. Instead of compounding into financial freedom, that $100K is eaten alive by depreciation, bad odds, and false promises. Now we gotta move on to D-tier assets. Weak, but not hopeless. Now, D-tier assets sit at one level above financial trap. They can work, but the odds are stacked against you here. They're too volatile, too illiquid, or too dependent on luck to build a stable foundation for wealth. People sometimes hit wins here, but most investors end up disappointed. Commodities like gold and silver land here in D tier, okay? They're often marketed as safe havens, and it is true they've preserved wealth for centuries. In times of crisis like 2008, gold spiked more than 25% in a single year. But zoom out, and the story looks different. According to the World Gold Council, gold's long-term annualized return over the past 50 years is around 7 to 8%, less than stocks and only slightly above inflation. Commodities don't generate cash flow, they just sit there. As a hedge, they make sense. As a core wealth builder, they disappoint. Single rental properties can also drift into D tier, especially for small landlords. On paper, it sounds simple, right? Buy a house, rent it out, let the tenants pay the mortgage. In reality, it's messy. Vacancy risks, property taxes, maintenance costs, and rising interest rates often flip the math from positive cash flow to negative. Census Bureau data shows that mom-and-pop landlords who just own one property, they often face the highest default and vacancy risks. Without scale, rental real estate becomes pretty fragile. And that is what ties D-tier assets together: fragility. They might work in perfect conditions, but they lack durability. They depend on timing the market, avoiding bad luck, or getting every variable right. And that's not always going to happen. In D tier, your 100K isn't destroyed instantly like it is in F tier, but it stagnates or bleeds slowly, and obviously that is not the goal, right? The goal is to build your wealth and not just maintain it, but grow it consistently over time. And we'll give you all the knowledge and skills needed to do that within the Alux app. We're already helping thousands of entrepreneurs and high achievers level up their lives financially, but also intellectually, emotionally, physically, even romantically. We're giving you the full package in terms of well-rounded wellness here, and if you download the Alux app and scan this QR code, you'll score 25% off your annual membership. I'll see you on the inside, but in the meantime, let's get back to our asset list, shall we? All right, C-tier assets. Average, but not really that exciting. Assets in C-tier are the middle-of-the-road stuff. They aren't scams, they're not traps, but they're also not engines of wealth. They usually keep up with inflation, sometimes even deliver steady returns, but they rarely accelerate someone toward financial independence on their own. Bonds are the clearest example here. U.S. Treasury bonds are considered one of the safest assets in this tier. Investors buy them for stability, not for growth, and stability is what they get. Over the past 30 years, 10-year treasuries have returned about 4 to 5% annually compared to more than 10% for the S&P 500. Bonds protect wealth, but they don't multiply it. They're the financial equivalent of parking your money in a garage. Safe, but going nowhere. Then there's REITs, or real estate investment trusts. They also sit in C tier. They give people exposure to property markets without needing to manage tenants or buy buildings directly. REITs often pay attractive dividends, making them popular with income-focused investors, but they're extremely sensitive to interest rate cycles. In 2022, when the Federal Reserve hiked rates aggressively, the FTSE Nareit All Equity REITs Index lost over 25%. Over the long run, REITs underperform broad stock market indexes while carrying higher volatility. They're useful in a portfolio, but not dominant. Then there are collectibles with expertise, okay? Art, vintage cars, rare watches. Unlike the speculative fads of F tier, these markets are real, and fortunes have been made by savvy collectors. Deloitte's 2023 Art and Finance report found that ultra-high net worth individuals now allocate about 5% of their portfolios to art. But here's the problem, okay? Liquidity. Selling a Picasso or a Rolex at the right price can take months, even years. Unless you already have the network, these investments often end up as status symbols rather than cash-generating assets. C-tier assets share one trait: they're fine. They won't ruin you, but they won't make you rich either. They function best as diversification tools, things that you sprinkle into a portfolio to smooth out your risk, but they're not the heavy lifters of wealth creation. But we're getting to those. Next up is B-tier assets. They're solid, but not the best of the best. Although, B-tier assets are where real wealth building starts to feel reliable. These are not flashy assets. They don't require insider connections, and millions of people have used them to climb into financial independence. They compound steadily, they're proven, and they're accessible. The only reason they aren't ranked higher is that other assets outperform them over decades or offer more leverage. Index funds are the cornerstone here. A simple S&P 500 index fund has returned about 10% annually since its inception. To put that differently, if you invested $10,000 in 1980, you'd have well over $900,000 today without even lifting a finger. They're cheap, diversified, liquid, and require zero management. Legendary investor Jack Bogle built Vanguard on the principle that most people should stop stock picking and simply ride the market. For the average investor, this is the cleanest path to long-term wealth. Then there's dividend-paying stocks. Those are also in B tier. Companies like Johnson & Johnson, Coca-Cola, and Procter & Gamble have raised dividends for decades. The S&P 500 dividend aristocrats, Firms that have increased payouts for 25 plus years have historically outperformed the market with lower volatility. Now, dividend investing appeals because it feels like cash flow. You literally get paid for owning. The downside is growth. High dividend payers often grow more slowly than reinvestment-heavy companies like Amazon or Google. Reliable? Yes. Explosive? No. Real estate portfolios at scale are rounding out the B-tier list. A single rental can be pretty fragile, right? But once you own 5 to 10 properties, the risk of vacancies or problem tenants starts to spread out. That is when real estate begins to feel like a system. According to U.S. Census data, about 70% of rental properties are owned by individuals, but only landlords with multiple units tend to see real stability. Done right, it's steady cash flow and long-term appreciation. The challenge is management, though. Even with property managers, real estate demands more involvement than buying index funds. The common thread across B-tier is repeatability. These assets don't rely on luck or perfect timing. They work for anyone who sticks with them, but they don't have the upside, the leverage, or scalability of the very top tier. So, what happens if you put $100,000 into B tier? That money is going to work. In index funds, it could compound into $1 million in 30 to 35 years. In dividend stocks, it could steadily pay you $3,000 to $5,000 a year in income while still growing. In real estate, it could be leveraged into multiple units, producing monthly cash flow. Moving on to A-tier assets here, they're powerful, but they are demanding. A-tier assets are where the wealth game changes. They've got the potential to generate serious wealth, but they aren't beginner-friendly, okay? They demand either a lot of capital, a lot of skill, or a lot of patience. But if you can clear those hurdles, they'll reward you far more than the middle-of-the-road stuff. Private equity and venture capital dominate the A tier, okay? Historically, private equity funds have returned between 12 to 15% annually, consistently beating public markets. A Bain & Company 2023 report confirmed that top-tier private equity funds still outperform even after fees. The trade-off is accessibility. These funds usually require at least $250,000 to get in, with your money locked away for 7 to 10 years. You also need the right network to even hear about them. We've got a video on private equity if you want to check that out. We'll link it in the description. Then there are franchises. Those also sit firmly in A tier. The model itself is rock solid. You're buying into a proven brand with marketing, systems, and customers already built in. Top franchises like Chick-fil-A, McDonald's, or Domino's can generate 6 figures in profit per location. And according to Franchise Business Review, operators average $80,000 to $100,000 in annual profit. But the barrier is massive, okay? Opening one up can cost anywhere from $500,000 to over $1 million, and not everybody gets approved by corporate. It's not that franchises don't work, it's that few people can actually afford to get a good one. Then there's commercial real estate. That's rounding out the A tier. While single-family rentals can be kind of shaky, commercial property, multifamily apartments, office buildings, or shopping centers scale income in a way that small landlords just can't. According to CBRE, U.S. commercial real estate averaged about 9% annual returns over the past 25 years, but again, the entry ticket is quite steep. Even a modest multifamily property might cost $1 to $5 million, and lenders expect significant equity up front. The pattern across A tier is pretty clear, okay? These assets are proven wealth machines that demand serious buy-in. They aren't risky fads, they're not dependent on luck, they're scalable systems that produce strong returns if you can afford to play. So what if you put $100,000 here? Well, I mean, it's barely enough to get in the door over here. It might buy you a minority stake in a small private equity deal, serve as a down payment for a modest commercial property, or cover franchise fees, but not the build-out. A tier shows you that capital is a gatekeeper. The opportunities are great, but with $100K, you're still on the outside looking in. And finally, we've got these S-tier assets, the wealth machines. S-tier assets are the crown jewels of wealth building, okay? They combine growth, leverage, and scalability in ways that lower-tier assets could never touch. At the very top sits owning your own business. According to the U.S. Census Bureau, over 70% of millionaires are entrepreneurs. A profitable business pays you twice. First, through steady cash flow, and later when you sell it for a multiple of earnings. For instance, a small SaaS company making $500,000 in profit per year might sell for $2 to $5 million depending on growth. No stocks or bond could ever deliver that kind of asymmetric upside. Next is equity in high-growth companies. Startup founders, early employees, or angel investors who get in early on the next Tesla, Amazon, or Nvidia can see life-changing returns. A $10,000 investment in Amazon's 1997 IPO would be worth over $1.6 million today. These are rare hits, but when they land, they build generational wealth. Another modern S-tier category is scalable digital assets. The creator economy was valued at over $100 billion in 2022, with top creators earning millions annually. Scalability is why digital assets punch at the same level as businesses and equity. The pattern across S-tier is leverage. Money, technology, or people work for you, not the other way around. Unlike lower-tier assets that depend on slow compounding or personal labor, S-tier assets multiply because they scale far beyond your individual effort. For the vast majority of people, smart investing is just putting your money into steady, proven assets that compound over time. Yes, okay, there are deeper layers, complex strategies, high-level plays, but you don't need those to build wealth. You just need consistency, patience, and the discipline to avoid the traps that we ranked at the bottom. Alrighty, Alexa, that's all from us today. We hope you enjoyed this one. Thanks for spending some time with us. We'll see you back here next time. Until then, take care.